The Fed's rate hike had a major impact on other countries' policies. Nations such as Mexico and India are also raising rates to fight inflation. Developed countries in Europe as well as South Korea are likely to follow suit. Rae-hyun provides a deeper analysis.
Emerging financial markets around the world are reacting to the U.S. Federal Reserve's recent rate hike. Last week's U.S. rate hike of 75 basis points, the largest in decades, led to many currencies losing their value against the dollar.
As we all know, U.S. keep on hiking interest rate, U.S. dollars remain strong, and Asian currencies definitely suffering.
Earlier this month, India's interest rate rose 0.5 percentage points to 4.9%. Citing the minutes of the Monetary Policy Committee's meeting, Bloomberg reported that India is likely to raise interest rates 2 more times this year. The Philippine Central Bank on Thursday also raised the key interest rate by 25 basis points to 2.5%, while mentioning another rate increase in August is possible. Latin American countries are on the same track. Mexico on Thursday increased its benchmark interest rate by a record 75 basis points to 7.75%. The Bank of Mexico said that it could raise them even further to tame inflation, which has surged to over 7.8%, double its original target. Argentina also raised its interest rate last week for the 6th time this year to 52%. That's up 3 percentage points from the previous mark, but the doors open to an additional raise as the government struggles to cool inflation expectations. Developed countries in Europe, meanwhile, are not an exception. UK interest rates rose further last week from 1% to 1.25% as the Bank of England attempts to stem the pace of soaring consumer prices. The European Central Bank earlier this week reiterated its intention to raise interest rates in July and September. Meanwhile, there's a possibility that South Korea could also increase interest rates in the coming months as currency volatility remains. Rae-hyun, Arirang News.